Hello, everybody. It's Craig Moser. Today is the 16th day of April 2021. I wanted to give you a little time and share some thoughts that I had about the various stock markets and bond markets and where this thing is all going. So let's jump right in if we can. Let's take a look, if we can, at my charting system here. And what we're seeing here is a chart of the Standard & Poor's 500 index. So it's stock index, 500 companies, heavily weighted to 5 or 6 companies though: Facebook, Amazon, Apple, Microsoft, Netflix, Google, those guys. So a lot of it is in that particular set of companies. But at the end of the day, if you don't look too closely, what you see here is a very nice chart. Now, this chart is a 2-year chart. And if we look at the upward trend, it has been a great trend and probably would have been about at that same place had we not had COVID. This is what COVID was. So for a long time, and this was 2020 right here, and when we bring this over, this was about November of last year before we got back to even. But for some reason, it's been easy to forget this because of the upside that we've had. So forgive me, but I need to explain a little bit of why this market is so strong. You have to admit, when you sit back and take a giant step back, we're not really that healthy as an economy right now. We just went through a pandemic. A lot of people lost jobs, worked from home, had to change a lot of what they were doing. There has been a lot, and I mean a whole lot, of stimulus money going into our economic system. There's going to be a consequence for printing all of that money. I kind of wanted to bring this into play and show you a little bit about this being the balance sheet of the Federal Reserve Bank, just so that we'll have some basis in fact to share. So I took this right off of the Board of Governors of the Federal Reserve System. This is their official website. And then looking at this chart right here. So hopefully you're seeing what I'm seeing. And what we're looking at is how much they had, for example, in July of 2007 on the books, as far as pretty much debt that they own, not debt that they've incurred, but debt that they own, typically by way of treasury bonds. So back in those days, $870 billion in 07, and that kind of stayed the same until we hit September of 08. And then our government was forced to act. We can debate whether it was a right thing or a wrong thing, but at the end of the day, they acted. They went to bail the banks and financial institutions out because they were having significant issues. So then the balance sheet started increasing, and the significance of this is that typically they don't carry this much debt on the balance sheet of a central bank. We did. So it went from, let's just say, $1 trillion up to $4.4 trillion. A lot of debt sitting on the balance sheet of the Federal Reserve Bank. And so that's atypical. We have not normally done that. So they quit printing the money that this debt was supporting around October of 2014. So somewhere right in here is where it kind of stopped, right in this range. And then just kind of sat there. Some of it started maturing and coming off. Some of it was actually the mortgage-backed stuff that they took from the banks that was still alive. And it was starting to drift down. COVID hit, and now that balance sheet is close to $8 trillion. A lot of money sitting on the balance sheet of the Federal Reserve Bank. So if you want to get bored tonight, you can't sleep, go get a money and banking book from Edward McKay or something like that, and read about how they create money and how do they back it, because this is a significant thing. When you look at the U.S. debt clock, which is sort of a boring, not boring, but challenging thing to look at. And you look at this and you say to yourself, we as a country, from a governmental perspective, owe over $28 trillion. It's a lot of money. So when you look at that, you understand now what they actually have as far as a budget over the last year and how much of that we didn't produce so that they had the money to have the budget. In other words, they borrowed it. So it's a very unsettling thing to think about the debt that we're creating over this time. If they do this infrastructure bill, this 28 trillion will bulge up to, somewhere around $30 trillion that our government is now put us on the hook to pay back. It's scary to me. Money creation, when you look at M2, we had 4.7 trillion back in 2000, and now we have 20 trillion. That's us telling you, point blank, they have printed a bunch of green paper, which is in the economic system now, money. So getting off of that and going back to the stock market, a lot of people have asked me, how come the stock market is going up so much? And there, in part, is the answer to your question. It has, there's a lot of money chasing those 500 stocks in the S&P 500. So if there's more money to buy stock, the price goes up. It's kind of supply and demand a little bit. So that's kind of what's happening. What's happening overseas? So we'll look at Europe, Australia, and the Far East as a place to look. Same sort of thing. Low interest rates, no real motivation to be in bonds or CDs or things like that. And so the question is, where does the money go? It's going into their stock market. Still less expensive from a price to earnings ratio than the United States, but starting to move up. Interesting, huh? Emerging markets. So emerging markets are multiple countries, not just China, but China is probably the largest player in this particular index. It's had a massive run followed by some consolidation. I wouldn't call it a drop, but certainly some consolidation where people have paused to take some profits here rather than just letting it continue to run. So there's basically the world in a nutshell between us, Europe, Australia, and the Far East, and the emerging markets. Back in our neck of the woods, what's been on a tear has been small caps. Okay, so small caps took off, really right in here, which was, right around October of last year, and has made a really big run in small caps. A lot of technology in here, a lot of startups and things like that. So not as safe as the S&P 500, but you can't argue that that's not an upward trend. All right, so let's look for a second. Let me do gold right quick. Gold, nothing big going on in gold. The dollar has started to move back up a little bit. So the dollar tanked, and now it's moved up some from its bottom, which was around January. But if you look at bonds, which is where I wanted to go, let's do a treasury that has a maturity of say 7 to 10 years out. And you say, okay, that's probably really safe and it's probably flat or something. But in reality, bonds have swooned quite a bit. So bonds ran up a lot. You can envision people buying treasuries when they became afraid back during the pandemic. And then from there, though, the longer end of the yield curve, the interest rates have gone up some on the longer end, which has impacted the price of bonds. If you're a bond owner already, hasn't helped you any. It's actually hurt a little bit. So just understand that bonds are not the same animal that they have been for the last 30 years, because over the past 30 years, we've had a significant decline in interest rates, and older bonds, even 10 years ago, were paying quite a bit more from an interest rate than the newer bonds today, which are paying very, very low rates. So maybe 1% or less for the majority of them. And you have to get out on the long end of the bond curve to get anything at even 2.5%. So just what's happening out there. So wanted to let you know that right now we are in risk on, meaning we are not trying to put big defenders into our portfolio to prevent us from having declines in the market. But instead, we have offense on the field and we are enjoying some of the upside in the market. Just be careful. Understand that things have their time and place, and don't either get too exuberant or too fearful as things move around a little bit here. But for the foreseeable future, our view is that the stock markets are going to move up some, and it should be our friend for quite a while, meaning at least to the end of the summer, quite a while. All right, you guys, I'm going to let you go. Thanks for listening. Hope I brought some insights to it, and we will talk to you next month. If you have any questions, just give us a call, 336-448-1086, or you can look at our website, Maestro Wealth Advisors. We have a podcast there. We run a radio show we have for the last 6 or 7 years, and that runs at 11 o'clock on 94.5 radio, or you can pick it up on the podcast. Make it a good day, and we'll talk to you next month.